At this point, we're now going to get more involved with the actual accounting. And I know sometimes, and I know this happens a lot, particularly in intermediate accounting, if you don't see numbers, you don't think it's important. But this time we'll start looking more at the statements. And we're going to look at the four fundamental financial statements. And that's the balance sheet, and they have lots of acronyms. So if you have not seen accounting before, I think this is what keeps accountants in business, just calling the same thing by many different names. It just confuses people, and you need us to explain it. So the balance sheet is also known, as you'll see, as the statement of financial position. The income statement could be called 1,000 things. The statement of profit and loss, the statement of operations, statement of earnings. The stockholders' equity statement is pretty much a statement of retained earnings. Cash flow statement, of course, we're going to save until the end. We'll do a little bit of that now. Out of this unit, the most important takeaway is articulation. And that is the ability for you to understand how the statements tie together. And throughout this semester, one of the things I am not going to make sure, I'm going to make sure you do not leave without, is your ability to understand how the statements affect each other. So when you buy inventory, what statements are effective? When you sell inventory, what statements are effective? Does it have a cash flow effect? And every time we look at the debits and credits and the journal entries and the mechanics, you're going to see an accounting equation. So eventually, I hope by the time we're done and you get to intermediate accounting, if I tell you you bought a plant asset, you're going to know what statement it goes on, what accounts are affected, and if it has a cash flow effect, and you'll do that like that instantaneously. That's the way your mind would have to work. Because if you get bogged down with, debits and credits, or if you get bogged down with too much of, I could have done that problem if you would have gave me the schedule. I would have put the numbers in the box. That's not going to work for you. So we want to make sure that when we're done with this learning objective, you get a good feel for articulation. That's going to be a skill that you'll build throughout. And by the way, that's the way a financial analyst works. Financial analysts would work, and again, as I said earlier today, it probably seems like last week by now, but I said that you need to think about how people are using those statements. Right? You're building those statements. How does somebody use them? And articulation is one of the key factors in statement analysis. And so here are your financial statements. And it's funny, I must have used, Tom Dyckman is one of the old authors on this book. And I must have used his books when I was in school. Because when I looked at this book, I said, "Chet, I thought I invented that," or I thought, because I've written a textbook which we'll use next semester, and I hope I don't get sued because a lot of what's in there is pretty much the same as this. This fits or articulates very well. But I look at the financial reporting model just like this. I draw it a little bit differently, but let me make some room here so I can continue this flow. And I only have one eraser here, so got my Fitbit stuff going. So here's the way it works. The first thing that I think we want to establish today is that a balance sheet is a position statement. In the old textbooks, they used to say that the balance sheet is a snapshot. It's a statement that is cumulative. It's at a point in time. So we start the year with a balance sheet, and we end the year with a balance sheet. Now let me tell you that the balance sheet is and we'll see this later, but the balance sheet is, of course, it's built off of this equation. The balance sheet is made up of permanent accounts. It is it's a point in time. It lists assets, liabilities, and equities at a point in time. All those accounts are permanent. They carry over period after period. They are cumulative in nature. So the balance sheet builds up. So for example, let's take your bank account as an illustration. Make a deposit today. Withdraw some money. Make some money on your job. Put another deposit in. Stop right there. That's the balance at that point in time. Okay? That's the balance. It's the cumulative amount. December 31st ends. That becomes your beginning balance for the next year. And how did that balance change? It changes through statements like the income statement, or the statement of cash flows, or the statement of equity. These statements are over a period of time, and they're flow statements. And by the way, what I mean by incomplete accounting cycles, on the balance sheet, what if you have a plant asset that has more life to it than just the end of this year? That cycle will continue. You'll use it to produce. It'll incur expenses. So the plant asset is going to continue to provide service going out to the future. But the income statement let's just take the income statement in particular, is going to be a flow statement with temporary accounts, completed cycles, and get out of the way. And you have changes for the specific year only. And what I mean by a completed cycle, I'm not going to worry about cash flow in the statement of equity. Just look at the income statement. Let's go back to your bank account example. Your bank account went up because of your earnings in 2016. At the end of 2016, your bank account changes from the beginning to the end of the year. What caused the change? Earnings for that year. Your salary, net of taxes. You made the deposit, and that's the flow. That's the change in your wealth. So the income statement is a flow statement. It's a temporary account because those earnings are only for what year? 2016. You want to pay tax on 2016 earnings. You don't want to accumulate those and next year pay tax on what? 2016, 2017? No. You want to pay tax on 1 year. So it's a temporary measure of 1 year. The cycle's complete, this year's over, and it has no implications for the future. Balance sheet has future implications. So the balance sheet carries forward year after year, and it's changed by income flows. It's also changed by cash flows as well, but let's just stay with the income statement for now. Now, what happens next year? Next year, this becomes the beginning, and the next year flows again. And then you've got, let's just use the income statement. And that's, again, a period of time. So you start with your bank account, get your salary, make the deposit, and at the end of the year, get your balance sheet at the end. And that's going to be, again, point in time. So when this year is over, those statements are no longer relevant. And the new statements, for example, the income statement, the cash flow statement, now become relevant for the next year. So if this was 2016, now this is 2017, and that's the way the accounting cycle works. Balance sheet carries over each year. It's cumulative. Income statement, the flow statements are only for the short period. As you measure it, those go away. Those cycles are complete. They're temporary in nature, and there's no longer any need to use that information in the balance sheet here. And then, of course, it just carries over. So those are the key financial statement links. So the flow statement, again, as I said, the point in time is the balance sheet, and then the period of time for the flow statements. Now, the reporting period could be a month, it could be quarterly, it could be annual. If it is annual, let me clean this up a little bit. If it is annual, it could be a calendar year or a fiscal year. A calendar year means it starts on January 1st, ends on December 31st. A fiscal year is used by a lot of companies depending on their cycle. Remember we talked about that cycle? Some companies will end their year at a point where their inventory is at the lowest level. So for example, retail companies, they have very odd year ends. For the year ended February 21st, or for the year ended January 30th, or something like that, they don't end because that's when your cycle is at its lowest peak, or is at its lowest point. Most government agencies will end their year on June 30th. And maybe that's their budget cycle. Rutgers University has a year end from July 1st to June 30th. When you work, you're going to find out that most of your clients will have December 31st year ends. Public accounting firms try to ask clients to change their year ends in order for you to spread out your work so you don't have all that concentration. So when I was in public, I had the misfortune, I guess, of having December 31st client, April 30th client, and June 30th clients, which meant that the work was spread out, but I had 3 closings. I had 3 busy seasons. So, 6 of one, half a dozen of the other, I guess, is the same work, but again, you could have year ends at different points in time. Okay. Nike is May 31st. Okay. Now, let's take a look at the accounting equation. Now, as again, we're going to talk a lot less broadly now. We're going to get much more specific. So when you look at the accounting equation, that is it. Also known as the balance sheet equation. As I said, it is a stock of wealth. The balance sheet is a stock of wealth. These are cumulative amounts. These are permanent accounts, and these represent incomplete accounting cycles. The assets, liabilities, and equities on that statement have future implications. The cycles are incomplete. The debt has to be paid off. The dividends have to be paid out of stockholders' equity. Inventory is going to be used up. Revenues are going to be generated. Liabilities, accounts payable will be paid off. So again, it will balance, and of course it is known as the statement of financial position. Now on Nike's balance sheet, we'll look at there, and again this is an abbreviated version. Notice that in the heading, one of the things that I guess, not that particular, but certain things have to look the way they have to look. So that when you build a balance sheet, name of the company's first, the title of the statement, and then for the period ended. So it says, you could say at May 31st or, as of May 31st. We have cash, non-cash assets, total economic resources are 18,594. Liabilities and equity are your financing activities. You've got obviously debt financing, and then of course you have your equity financing. One thing to notice here is that contributed capital is the capital that's contributed by stockholders. Contributed capital is what is paid in by stockholders. Retained earnings is what is retained by the company net of any dividends. Now, one of the things I was going to say here, it says other stockholders' equity. We're not going to worry about that right now. They have obviously other components of equity. So contributed capital, there are 2 ways to get capital in the equity section. One is contributed by shareholders when you sell the stock. The other is to retain earnings over time. The retained earnings account, of course, is like a history book. It's the historical record of earnings since you started your business that you have not paid out in dividends. The other important point, and when we look at the concept, you'll see this, the other important point is that contributed capital is historical. In other words, if this is Nike, as of 2014, that stock could have been issued in 1985. And that's the value that they received in 1985. So $5,868,000 is an historical amount they collected from stockholders. That does not change with market prices. So one of the things I wanted to be sure, and I'll say this again, is that the stock on the balance sheet does not reflect today's market price. Does not reflect today's market price. So that's the balance sheet in general. Assets have to equal liabilities and stockholders' equity. Do you have any thoughts, any questions on the balance sheet at all? Yes?
It's like retained earnings and cash, there's a difference there?
Yes, absolutely. Absolutely. That's a great question, because retained earnings may start out as cash,
Yeah.
but then it becomes what? It gets plowed back into operating. So some of those earnings could have been used to buy non-cash assets, plant assets.
Okay, so that's why there would be a difference.
Yeah,
Cash
yeah,
would be
it's a
more.
very good question. Retained earnings is not the same as cash. In fact, retained earnings may have no relation to cash at all. It could have been generated, that cash could have all been borrowed cash, and all of the earnings that you have could have been plowed back in terms of plant and equipment.
So would cash be like a line of credit you have for that company?
Yeah.
Okay, so.
Sure.
Got it.
Yeah, I mean, cash could be from anything. It could be a line of credit. You know yourself, if you have a credit card that says you've got, $5,000 line of credit.
Yeah.
When you borrow against that, that's, again, your cash line.
Okay.
So that cash could have come from some of these liabilities. So you don't, and by the way, you don't need cash to pay dividends either.
Oh, you can pay it out in shares?
Yeah, you can pay it in shares. So dividends can be paid in many forms. Property, dividends in kind, they call those. But stock dividends also exist. All right, good. Any other comments or questions on the balance sheet? Yeah.
Can the plant investments be cash or non-cash?
The plant assets
Or plant
would be the non-cash assets.
Okay.
Yeah. Cash is essentially going to be money in the bank, or it could be some type of commercial paper, it depends.
Okay.
But it's pretty much cash is the way we know it. Money market funds, certificates of deposit, savings accounts, checking accounts. Aside from a retail outlet, cash is really not a big number on the balance sheet. You don't need much cash to operate in Nike on a day-to-day basis. So another good question. Any others? I want to clarify everything, so please ask. I don't want to move on in case you have any other questions about the balance sheet. Non-cash assets would be inventory, where, again, it's a condensed form that you're looking at right now. We're going to, obviously explode this into pieces in a bit, but you've got inventory, accounts receivable, you might have supplies, you might have plant assets, buildings, land, could be in the non-cash assets. So non-cash assets could be made up of anything other than cash that you're going to use in your business. Anything else? You can always go back. All right. What about revenues and expenses? Income statement. Income statement is the listing of revenues and expenses, your net income and your net loss over a period of time. And as I said, the income statement is a flow statement. These are temporary accounts that are only used to measure the change in wealth. Okay, so if you look at the balance sheet as a stock of wealth, you could look at the income statement as a change in wealth. It's how your resources or how your wealth changed over a period of time. And again, that period could be a quarter, could be a month, could be a year. And these are temporary accounts. Revenue, so again, on your tax return, I'll make it as individualized as possible. And by the way, if you ever, what happens a lot in accounting is you say, okay, this is, very different discipline, so it's got to be difficult, and it probably is not going to make a lot of sense a lot of times. Think of it as on a personal level. All of us do accounting, right? So, for example, in our tax returns. So you would only want in your 2016 tax returns your 2016 wages, correct? And that's exactly what happens on an income statement. It's only for one period. It's the change in your wealth for one period. And it's temporary because next year you start with what? Your first paycheck starts with zero balance.
What do you mean by wealth? I'm not sure.
Yeah, change in wealth is the way we look at the balance sheet. It's the stock of wealth, net assets. So, for example, if I wanted to look at your financial condition for a mortgage, what would I look at? I would look at your wealth in the sense of assets minus liabilities, right? Your net assets. How does your wealth change? Your wealth will change by your income and expenses. So the change in wealth is the change in your financial position over a period of time. Change in financial position over a period of time. Now, the income statement is a pretty simple model, and we're going to start very simply. And by the way, there's all the AKAs there. Income statement, statement of income, statement of earnings, statement of operations, statement of profit and loss, and the list goes on. P&L, Okay. All right, so here's Nike. And notice the difference in the heading. It doesn't say at May 31st. It says for the year ended May 31st. That's the flow. That's the twist. And sales, increase in equity from selling goods and services. And of course, these are the expenses that were incurred. And again, this is an abbreviated income statement. What I like about the book is it actually uses live financials, but it puts it into an intro format. So, again, if this was an intro book, these numbers would be hypothetical. But here, at least, you got the actual numbers. What I also wanted to show you is what you see next. And this is extremely important for a manufacturing or retail company. We're going to break up their expenses into two categories. One is known as the cost of goods sold. You could also have the cost of services sold. And then the other is other operating expenses. So, for example, if you are, let me make some room here. Revenues of sales. Let's say you sell a product for $10. If it cost you it obviously costs you to buy the product if you're going to resell it, or it costs you to manufacture it. Let's say that's $6. And the difference is called the gross profit. Now that's a very important definition, a very important measure, because that tells you how much of your sales dollars remain to cover operating expenses. I mean, obviously, if your profit margin starts to shrink over time, you'll have less income available to cover what? Operating expenses. So your net income is $1 in this case. So you would want to watch your gross profit or your cost of goods sold very carefully. sometimes put this in percentage terms, but we'll do that a little bit later. So gross profit is a key measure of profitability. It tells you how much of your sales remain to cover your operating expenses. How much remains to cover operating expenses. So what if your cost of goods sold kept going up? How could you stay in business? What would you have to do? You'd either, if you had no control, for example, let's say you're selling a product that you're buying from a few sources of supply, and now those prices go up. What would you need to do? How would you maintain profitability?
Raise the price.
Raise selling price if you could, depending on the market, or cut costs. And that's what happens sometimes. When you're in a position where you can't raise the selling price, you may have to cut the cost of manufacturing, make the product a little cheaper, or cut your operating expenses. Now, if you've ever seen, I know probably you're too young to watch anything on PBS, but every once in a while they have a special or a business expose, and they talked about Walmart. And Walmart's always accused of moving businesses overseas. But what happens is they put a lot of pressure on their suppliers. They want to come in at a certain margin, profit margin, and they want to keep their cost of goods sold as low as possible. And that forces sometimes you to go outside of the US or to manufacture, and they don't want you to cut the quality either. So they will, and they actually showed you, it was really interesting, they have a hall, a long hall with rooms on each side, and you have appointments with buyers. And the suppliers come in, and you're meeting with Walmart's buyers and saying, look, if you can't come in, let's say for a toaster, if you can't come in at $10, we're going to go elsewhere. Don't worry, we'll do it. How do they do it? They just move offshore. I mean, that's what the argument, I don't know how true it is, but that's the argument that they were making. So you've got to be able to control that cost of goods sold. Now, financial analysts will watch this, on a longitudinal or over time. We're going to watch the trend. If we see that starting to go up or your profit margin go down, it's going to make an analyst get a little shaky about your ability to generate profit. So the bottom line here is that we're going to pay a lot of attention to the cost of goods sold. And for us, in this course, we're going to look at different accounting methods for inventory. If anyone took a basic accounting course already, or you've worked in accounting, there are different methods of accounting for inventory. Some methods will cause cost of goods sold to be higher or lower than others, and that'll have an effect on profit. And once again, you got to know the method that's used that could be biasing that ratio. Okay. All right, now, one last statement, I guess, or two more, and then we'll do that and we'll take another quick break, is the statement of stockholders' equity, and it is another flow statement, and that shows you the change in equity over time. This would include the amounts that are paid in by shareholders. When a stockholder is buying stock, there is a par value on the stock. You could pay face value, par, or excess over par value. So that, and again, these are just definitions. Whatever you see today will be explained in detail in separate chapters. But right now, the amounts paid in, let's say you issue one share of $2 par value stock. In the market at $10. So let's say you go to the market with an initial public offering or a secondary offering. You sell that stock for $10. It's got a par value of 2. That means on the balance sheet, you're going to see the common stock at par at 2. And you're going to see additional paid capital in excess of par at 8. So on the balance sheet, par value is the face value of the shares. Anything over that goes into additional paid-in capital or excess over par value. Now, this may seem trivial, And right now, it is kind of trivial. Par values are very low. I mean, they're not very meaningful these days because of the change in laws, which I'll explain. But I will tell you that in some states, dividends could be paid out of additional paid-in capital. And that's why we keep that separate. I mean, we could just leave it at that. It does get a little bit more complicated. Preferred shares. The two classes of stock you generally see are common and preferred. Preferred shares are a very, very small percentage of a company's new share issues. Does anyone know what their preferences are? What are they preferred? Why are they preferred?
They get dividends first.
Yeah, dividends and assets and liquidation. So preferred shares have a dividend preference over common. That's the primary dividend preference over common. Preferred shares are a very, very small percentage. Now, in my example, this was the market price, let's say on June 9th, 2016. If I go ahead and I look at the financial statements of this company 15 years from now, it doesn't change. Right? That's the amount that was paid in, and that's the historical amount that stays on the balance sheet. Now, also, we have retained earnings. And that's, again, the historical record of the company's earnings that were not paid out as dividends. Retained earnings is the historical or the cumulative record from the very beginning of the company's business until today. And of course, we have other sources of equity changes. This, just for example, I mean, there are so many, but I'm just going to give you one. Treasury stock. What is treasury stock, by the way? Does anyone know?
It's what the company buys back its stock.
Yeah. Company buys back its own shares. That's not an investment. You're just buying it back and holding it in the treasury. Now, we're not going to get involved with all the reasons for it, but why do you think somebody buys back their own stock?
To increase the value.
Yeah, it's just one way of raising stock prices to take shares out of the market. Right? So you buy back your own stock. And hopefully you don't see it soon, but when there's an economic downturn, that happens quite a bit. There may not be better investment opportunities for the company, so they'll buy back their own stock, and it raises stock price. And they also use it, by the way, for employee stock options, employee stock purchase plans, in a merger and acquisition. If I'm going to swap shares with your company, I'll use Treasury, because it's much quicker. I can use it faster. Because if not, I've got to go and issue new shares. So if you had an employee stock option and you had the right to buy 10,000 shares from my company, if I don't have them in the treasury, where do I get them from? Got to go in the market and issue new stock. I'd have to go and register new shares. This way I don't have to register the stock. I can just get them out to you without any formal registration. All right, so let me just show you what an equity statement looks like. Then I want to give you a quick stretch. This is what a stockholder's equity statement looks like. It's pretty much, again, a flow statement. So the company's name, statement of stockholders' equity, it's going to be for the year ended. It's another flow statement. It really reconciles the accounts on the balance sheet. I think the best way for you to look at this is a reconciliation. So how did contributed capital change? Well, it went from $5,187,000,000, and then we issued stock for $523 million, and then we had maybe other changes. Maybe we had employee options exercised of $158 million. That's how contributed capital changed. How did retained earnings change? Well, net income minus dividends, and then there's some other adjustments which we don't need to worry about right now, and that's how that changed as well. So it's a reconciliation of the beginning and ending balances of stockholders' equity. And now I think you want to start to think about articulation, where, for example, where did the 2693 come from? What statement? Net income. Where's it coming from? What statement? Income statement. And where would I find the balance, the ending balance of stockholders' equity? Balance sheet. So these numbers, we're going to talk about these linkages after the break, but these numbers will all tie back together. And that's known as articulation. And that's one of the things you have to be very careful to ensure when you start playing with some of the numbers. All right, so let's do a 10-minute, another stretch. This is not a subway break or anything like that. You can't go over to the other side of campus. So just take a quick stretch, and when we come back, we'll wrap up this learning objective and move on. Okay. We're going to look at the statement of cash flows, and then we'll take some questions, and then move on to the last part, or at least one of the last parts, and that's going to be the articulation. All right, so on the statement of cash flows, I mean, when you look at this, we will report the change in cash, and this is a very important statement, because what it's going to do, it's going to scrub away all of the, I guess, accounting nuances that we use and get right to the cash. So that's page 45. Yeah. There we go. Okay. So this will be the net cash flows from the 3 cycles. You can see how much cash you generated from operating, how much cash you generated from investing, and how much cash was generated or used for financing over a period of time. Now, once again, that is a flow statement. Now, this will be different, as we'll see in a few minutes, than operating cash flow will be different than net income. So we'll find out that, let me just get this on the page, there we go, okay. So that obviously revenues and expenses that we'll talk about in this course are going to be built off an accrual basis of accounting. We're going to be measuring economic activity. So, for example, if you worked 1 week and the year ended, but your paycheck is next week, we have an expense that we call wage expense, but there's no cash flow. If we sell products in the last week of the fiscal year and we have a receivable from our customers, but we didn't collect the cash, we have revenue but no cash flow. Depreciation is an example of a non-cash expense. When your car depreciates, you're losing wealth, you're losing income in a sense because you've got an expense, but there's no cash flow. On the other hand, what if you collected a receivable? So you sold something last year, you collect it this year. Is it revenue? In 2016? No. All right, the sale was in 2015. You had a receivable, but you collected in 2016. Not revenue, but cash flow. So again, it's a matter of, we'll see, when we look at our accounting statements, we artificially truncate the life of the business into artificial periods of time. So let's say we have a sale for 1,000, and we collect 1,000 in the next year. This means that we have revenue or we have no cash flow. In the next year, we have no revenue, but we have cash flow. So on the income statement in 2015, you'd see a sale of 1,000, and let's say you have no other expenses. Now let me just abbreviate that a little bit better. Clean that up. Let's say you have no other expenses, no other revenue. So your income statement is 1,000, and your operating cash flow is 0. In the next year, income statement has net income of 0, but has operating cash flow of 1,000. So the point of this simple example is to make sure you're very clear that earnings and cash flow are not always in sync. And that's true with you as well, as an individual, right? You work this week, but your paycheck comes next week. Use a credit card. Doesn't mean you don't have an expense, you just didn't pay for it. So it's the same logic. It's the same logic. So the way we map out revenues and expenses will be a timing that is different than the cash flow itself. Now let's look at that for a second. Let me see if you have any comments or questions on it. You sell something in 2015, you collect it in 2016. Your income statement shows profit in 2015, but no profit in 2016, but yet you got the cash. So when you look at this, it might seem counterintuitive that you could have income without cash flow, and you could have cash flow without income, but it's very possible. And this is some of the things you have to think about. And I think today, the main takeaway will be to make sure you start thinking and think about a lot of these issues. We're going to get down to the specifics, so today's just a kind of a broad shotgun, but we will get down to the specifics. But does that kind of bother anyone, or do you want me to give you another example, or I don't want to just say any questions, because I know if I say that, nothing happens. Does it bother you? Yeah.
Yeah, you totally lie about
What's
things.
that? What, in the accounting?
Yeah, you
Yeah.
can just say, oh, I made all these sales year
Right.
after year, and then, but like, what if you can't collect for like 120
Ah,
days?
okay. Well, that's where the accountants and the auditors come in. First of all, the purpose, and this is a great question, and we're not being deceptive here, because what we're doing is by reporting net income of 1,000 in 2015, we are providing you with information to make a projection
Okay.
of cash flow. So we expect that to be converted into cash at some point. Now, what if we don't expect to collect it? We have ways of handling that. We've got bad debt allowances. We look at the receivables. By the way, if those receivables were worthless, we'd write everything off, and we'd show no income in 2015. So we have ways of handling that. So we do evaluate the receivable. We evaluate the collectability of that sale. So great question. And essentially what we're doing is that net income becomes a basis of, and that's why we said, yeah, this cycle is complete, but we use it to forecast future cash flows. How do you value a business? Fred, you mentioned before about some mergers and acquisitions. How do I know how much to pay for a business? I had someone ask me a question once and said, I have a partner I want to get rid of, and I want to buy him out. I said, fine. He said, I got a car that's a truck, a couple of trucks that are worth maybe 30,000 and stuff, so I'll give him half of that or something like that. So you can't do that. I said, because you have to think about the future cash flows that your business is going to project. And he goes, well, I'm not on Wall Street. I said, yeah, but you got to value the business properly. And you value a business based on future cash flow projections. And future cash flow projections can only come from current income with a growth rate estimated. So it's a great question. So you're not really misstating anything. You're just providing information, hopefully, that will allow users to make those proper judgments with respect to valuation. Yep.
So wait, is revenue then your projected cash flow, or that's
Well,
comprised of?
Your net income with, if you're building a financial model, a projection, you start with net income. and then you make adjustments. So for example, let's go back to a merger deal. If I was acquiring your company and you had $1,000 in sales, if I'm forecasting out a growth rate, it may be 10%, or I might say, well, it'll be less than 10% because I know that once I buy your company, I'm going to lose customers. So Walgreens buys Dwayne Reed. You know, I don't know, Dwayne Reed's all over the place. I guess you have no choice. You're going to run into one eventually. But let's say this bothered you. You do lose some customers. You know that for a fact, if you sell a business, especially if you have a sole proprietorship, medical practice, dental practice, restaurants, you sell a restaurant that's a different owner, you lose, I mean, I guess the estimate is about 1/3. Initially, you get a 1/3 loss of business because of that. So when I'm projecting out, I have to build in that loss of business as well. But that's your starting point. Net income becomes the starting point for those projections. All right, any other questions? Or any other comments? So again, very broadly today, we start thinking about cash flow versus income as being different. Now, this is a very abbreviated version of Nike's cash flow statement. Again, it's another flow statement for the year ended. We will have categories. Cash flows will be broken up by categories. We're not going to play with this now. It's chapter 4. I just think chapter 4 is too soon to do a cash flow statement. We do it at the end of the semester when we're 1,000% sure that we understand accrual-based accounting. So I want to be sure, before I start going into projecting or going into building cash flow, I want to make sure you understand how I get my accrual-based or my accounting-based financials. So Nike, 3 forms or 3 cycles: operating, investing, and financing cash flows. Obviously, each one of these cash flows will tell you something. We'll go into that later, but just on the top side, notice that Nike seems to be using lots of its operating cash flow to finance investments, maybe paying off some of its debt. Because if you notice what happened, they generated $3 billion from operations. They used $1,207,000,000 in investing, and they used $2,914,000,000 to pay off debt. Their financing, they paid off debt, and now their cash decreased by $1,117,000. Notice also that these go back to the balance sheet, right? The ending cash. So this explains the change in cash. It explains the change in cash, as we'll see, and we'll look at the articulation in just a minute. Okay. All right, so we will do lots more on cash flow. So once again, we go back to our statements, and again, the balance sheet is permanent. And it's the point-in-time statement, and to review, the income statement is over the period of time, or the flow statement. And here are the linkages. This is known as articulation, the way the statement's articulated. If you wanted to find out, the question is, how did cash change, or what caused the change in cash? And again, remember, sometimes you have to think about the sources of cash, not necessarily the amount. Did it come from operations? I mean, what if a company had negative operating cash flow, but positive financing cash flow? What does that mean? That means they can't generate cash from operations, but they're borrowing money. So positive cash flow doesn't mean a lot if it's coming from debt. Well, what if you're selling off plant assets? So you look at investing, if you have positive cash flow from investing activities, that means you sold more assets, more plant than you bought. May not be a good sign. I mean, if Rutgers sold off its buildings, it doesn't have any productive capacity, so unless they go 100% online, it could be a bad sign. So you have to look at how cash changes, and therefore, statement of cash flows. The equity changes are reconciled on the statement of stockholders' equity. And of course, changes in operations and retained earnings will be the statement of income. Now, don't forget, where do you find the ending cash balance here? Balance sheet. Where do you find the ending balances of stockholders' equity? On the balance sheet as well. So these will also tie back to the balance sheet. So you'll also find them on the balance sheet as well. And if you look at, and this is kind of hard to see, and anytime I make a presentation, let me bring this down. Anytime I make a presentation, I always say this is the obligatory slide that you can't read. Because anytime you go to a presentation, by the way, here's a slide you can't read, and I don't know why put it in. Look, the textbook figures I didn't. All right, but you have it in front of you, hopefully. So we're just showing you that, of course, the cash on the balance sheet is going to be on both balance sheets. You'll find them on the statement of cash flows. We go back over here. So the balance sheet, you've got the beginning cash balance, you can see it on the statement of cash flows. The ending cash balance, you see it on the statement of cash flows as well. You notice that the ending stockholders' equity, the $10,824,000, is also going to be up in the balance sheet as well. And of course, the net income would be on the statement of stockholders' equity. Remember, the statement of stockholders' equity, predominantly when you look at the retained earnings, it's net income minus dividends. So when you have a chance to look at this, make sure you see how those would flow through. And obviously, the most important linkages, net income into retained earnings or net income into stockholders' equity, cash on the balance sheet into the statement of cash flows. Also, again, notice that what they're trying to show you here is that the beginning balance sheet and the ending balance sheet are explained by cash flows, income flows, and the changes in stockholders' equity. All right, and finally, the last issue that we'll look at is just to remind you that, let me just get these, is that there's a difference, I said this earlier today, there's a major difference between financial information and financial statements. In the statement, in the financial statements, you're going to see balance sheet, statement of cash flows, statement of stockholders' equity, income statement. But what other information are you going to get? When you look at an annual report, there's going to be a management's discussion and analysis, the MDA section. And in that section, you'll see management's explanations. And has anyone ever seen a 10K? Any work with any financials before? Yeah. Okay, so you know that there's an MDA section in there. That section is mandated by the SEC. It is the content, the general topics are mandated, but not the specifics. So they'll talk about operations. They'll tell you why gross profit increased or decreased. They'll give you an explanation of why debt went up or went down, if there were any mergers or acquisitions. So they explain all of those changes for you. And it's a good place to start. And the reason why I'm bringing this up, we do this again in Intermediate 1, is you do have a research project and you do have lots of cases to work with throughout the curriculum. But next summer, you've got a research project to do. Of course, the independent auditor's report. So going back, I know Fred mentioned about my example here. Yeah, we've got statements, but they have to be audited. And the independent auditors will be, as you know, and you'll see them all here, Big Four and mid-sized firms. By the way, they provide, we're going to look at some of this a little bit later in this book, but does anyone know what they provide, what kind of assurance? And they did change the name of their auditing divisions or departments to assurance. So you're going to say, I'm an assurance associate. In my day, you worked in auditing. It's assurance. What kind of assurance are they giving you? Has anyone ever seen an audit report? It basically says that the statements present fairly in all material respects. So all the auditors are telling you is that the statements are free from material error. Material doesn't mean there aren't any errors in there. And the presentation is fair. It's not exact. So when you're an auditor, you're not opining on precision or 100% accuracy. You just make a statement that based on our review of the evidence, we believe that these statements are a fair presentation and they are free from material error and they are presented in accordance with generally accepted accounting principles. So those are the elements of an audit report. Now, one interesting fact that you probably, or you may not know, quarterly statements, they're huge, right? 10 Qs. Everyone wants to see the quarterlies, right? You got the quarterly statements coming out. Are they audited? Does anyone know? Nope. Quarterly statements are not audited. Quarterly statements are unaudited statements, and what you do as an auditor, so let's say you're working for Deloitte or, Eisner Amper or Markham or any of the accounting firms, you'll go in and have discussions with management. You'll talk to management. You'll do some ratio analysis. And we do some ratios here. I skip a lot of them and I bring them in as we need them. But, and based on those ratios, you'll ask questions. So you'll ask the questions like, hey, gross profit went up by 20%. What did you do? Or operating expenses went down. How did you do that? And you document that. And as long as you do a review and it's reasonable, the quarterly statements get issued. But they're unaudited, and they're stamped unaudited, and it's kind of like let the buyer beware. Now, we're going to see something a little bit later in a conceptual framework, and that is, are quarterly statements relevant or reliable or both? What do you think? Well, if you had to weigh them, when you look at quarterly statements, are they more relevant or more reliable to the market? They're less reliable, but more relevant. And we trade off. And that's what we do in accounting. We trade off relevance for reliability. What's the most accurate statement? Well, maybe the annual, but really the most accurate statement is the one when the business terminates. But you can't wait that long. Right? That's venture accounting. That's when accounting was invented by caravans. You had a joint venture, or you would form a company just to go out and explore, or do some prospecting. Come back. What do you got? Got $10 left. Okay, we made $3, and that's it. Game over. You close up shop. But you can't do that because the market demands information on a more timely basis. So quarterly statements are more timely but less accurate. They're relevant because they're timely, but they lack what we call faithful representation. So you'll see that in the quarterly statements. Okay, now the footnotes, something we don't see much of here. We spend a lot of time on this in intermediate accounting. There is a lot of information that is not on the balance sheet, income statement, statement of cash flows, but goes into footnotes. Now, there's been a lot of research that's done that proves that people, well, do you read the footnotes in the textbook? I was reading this text and skipped on a few of those myself. People don't like to read footnotes. If I did the same, if I replicated the research that's been done over and over again, split the room in half, you get information on the balance sheet or the income statement, you get it in a footnote, you put more weight on it than in the footnote. The footnote is given less weight. It doesn't mean that if something's in a footnote, it's not as important. It just means that it may not be capable of being measured properly to be recorded. So what about a contingency, a lawsuit? You need to know that Apple's being sued, or Ed Sheeran's being sued right now, right? For $20 million. One of his songs, Photograph, I think is exact. I have a degree in music, so I was hanging around looking at the sheet music, and it's pretty close. I don't know if it's close enough, but it's pretty close. You can sue over a melody, not a chord progression, right? So chords and titles, you can do whatever you want, but this melody was like almost exact. So if he had a set of financial statements, he would have to disclose, I am being sued, and with some statement that my attorneys believe that it will not have an unfavorable outcome, but whatever it is, it's got to be in there. And to me, that's when you talk about projecting future cash flows, I've got to know that you may have to pump out $20 million. And by the way, that number's way higher than what you're going to settle, for eventually, but that number's got to be disclosed. So footnotes provide you with information on things like contingencies. And then, of course, we've got other forms of information. We've got regulatory filings, we've got SEC filings. And by the way, you may start to think about the difference between the annual report and the SEC's 10K. They are different, and we'll explain that as we move along. There's also the 10Q, which is the quarterly. So if you're filing with the SEC, and we're going to get into that. This is the annual and the report. And this is the quarterly. And you have to file with the SEC. if your securities are publicly traded to a certain number of shareholders. We're also going to look at press releases as other information. In the opening part of an annual report, not in the 10K, you get the letter from the CEO or the president's letter. And that president's letter is going to give you their overview of the company and the company's not only current but future prospects. And you are responsible for that, by the way. If you're on an audit, you have to make sure that if the president says sales were 18 million, as part of your audit, you got to make sure that sales are actually 18 million. I mean, you have to make sure that the numbers are consistent between each other. So we do have lot of the sources of information.